Hey, what's up, stock compounders? Brad here. So today I want to do a Q&A, a question and answer session. Normally I do these on Saturday, but with 13F season, I just had so much that I wanted to cover, so this got pushed back a little bit. So let's dive right into the Q&A. Question 1, would you be open to discussing your watch list of stocks? This was asked in a comment on one of my videos. Absolutely, I will share my watch list. I'm going to make a video sometime this week, kind of going through my watch list. There's only 5 stocks on there right now, 5 companies, and they're currently overpriced anywhere from 6% to 69%. So, I'm not buying any of them at the moment, but certainly with that one that's only 6% overpriced, it's getting close to my buy price. So I'll make a video about that soon, talking about those 5 companies. Second question, why is Buffett buying a gold and copper mining company? So, with the latest round of 13Fs, we found out that Berkshire is buying bought Barrick Gold in Q2 of 2020. Now, we don't know who bought Barrick Gold, whether it was Buffett or Munger or Todd or Ted. We don't know who bought it. My sense is that it wasn't Buffett. Buffett doesn't like to put, $500 million into something. He likes to find opportunities where he can put multiple billions of dollars to work. And he historically hasn't been very enthusiastic about gold. So it's hard to imagine Warren made this purchase. But again, it's only like 0.25% of Berkshire Hathaway's equity portfolio. So, I'm not getting too excited about it. But again, I'd be surprised if it was actually Buffett who made that purchase. Question 3, what investing books am I reading now? So I just read The Acquirer's Multiple by Tobias Carlyle. And I didn't really know what it was about going into it. But it's, in the book, there's a lot of talk about the magic formula from Joel Greenblatt. For those of you who aren't familiar with the magic formula, it's basically combining 2 different metrics to find companies that are both cheap and companies that are good, right? So, Joel Greenblatt is looking for a combination of companies that are cheap and good. According to earnings yield, that would be the measure of cheap, and then return on invested capital is his measure for good. Now, what the Acquirer's Multiple argues is that if all you do is focus on the cheap companies and forget about how good they are, you're actually going to do better in the long term than if you buy companies that are both cheap and good. And he showed, just buying cheap companies as compared to a magic formula style investing approach. Supposedly the Acquirer's Multiple approach outperforms the magic formula approach by like 2% a year, something like that, where it's like somewhere around 16% for the magic formula and 18% for the Acquirer's Multiple. And his big thing there is if you have that 2% outperformance over, decades, it's going to make a big difference. You're going to end up after 30 or 40 years with a much bigger chunk of change than, say, a magic formula approach. So I'm buying the book. I just bought the book. It hasn't arrived yet because I really want to look at these charts and, take notes, really digest it more in print rather than listening to the Audible version, which I did recently. But, I have a bit of a suspicion in terms of how robust are these back tests. How many different scenarios were run. is it statistically significant, this 2% improvement for the acquirer's multiple as compared to the magic formula? So that's really what I'm going to be looking for buying the physical book, to try to parse that out. And another thing that kind of annoys me, but I can't really fault him for it, the acquirer's multiple is like a paid service. Okay, now there's a free version where I think you can look at like the 1,000 largest U.S. companies, and it'll give you kind of a ranking order based on the acquirer's multiple. But if you want smaller cap stocks, international stocks, you've got to pay for the service. The thing I really like, as a cheapskate, as a value investor, about the magic formula is you can look at it for free. You don't pay anything to go to use the magic formula stock screener, which obviously I like that. So, I'm still formulating an opinion on it. I want to dive into the physical copy of the book, and then hopefully I'll have some more clear thoughts on, which might be more profitable going forward. Because I am doing a test right now with the magic formula with a couple tweaks in terms of, my own filters that I'm using to select magic formula stocks within that list from Joel's website, and also considering holding those companies longer than just a year, which the magic formula is supposed to be a very automatic approach where you're really just buying and selling after a year of holding. I think there's value to be had in, especially if you're methodically picking companies out of that magic formula screener, to holding those longer than a year. So, of course, I'm going to keep you guys posted on that. So that's one, the acquirer's multiple. The other one I ordered from Amazon, also by Joel Greenblatt, who came up with the magic formula, is called Common Sense. It hasn't actually been released yet. I pre-ordered a copy. And what's interesting about that book is it seems to get into equality in terms of capitalism and how to invest in a way that supports equality, especially in this time we're living through where obviously racial injustice is a big topic on everyone's mind. And it's something that's very interesting to me. I'm actually doing some racial justice workshops to try to expand my own kind of views around systemic racism. So that's another book that I'm looking forward to reading. New release from Joel Greenblatt. Next question, what was my biggest takeaway from Lilu's 2006 talk? So I just did a video on Lilu's holdings. We found out yesterday that he added Google and Facebook to his Himalaya capital management portfolio. And I hadn't watched this 2006 talk yet. It's on YouTube. I think it was in Bruce Greenwald's Columbia Business School class. And it's like an hour and a half, something like that. I watched it on 1.5 speed. So it took me like about an hour to watch. And it was a really good talk. My biggest takeaway from that talk, Lilu, he thinks about 95% of people who are in the stock market, who buy stocks, treat stocks like they're pieces of paper to be traded fairly frequently, and really short-term kind of horizon on those. And so his big point was that if you're in the 5% that treat stocks like it's a part ownership in a business, that's a whole different game to play. And he thinks it's a much easier game to win if you buy stocks as partial ownership of these businesses and you understand the business and you're in it to let the business make you money over the long term, rather than to play the pricing game, to try to forecast short-term price movements. That's a very difficult game to play, a very difficult game to win anyway. It's easy enough to play. So that was my biggest takeaway, just this reminder, which obviously as a value investor, I know this, but it's so easy to forget about that, to kind of get swept up in these short-term games where you see people making money really fast in, say, electric vehicle companies or SPACs, whatever the flavor of the week is. It's easy to get pulled in that if you see people making money, or at least you think people are making money. If you see that happening for long enough, it's easy to get off track, get off of the path, the proven path of kind of buying stocks as partial ownership stake in a business and letting the business make you money over time. So that was my biggest takeaway. Nothing new, nothing groundbreaking, but easy, something that's really easy for people to forget. When a stock you own hits intrinsic value, do you start selling? Do you sell all of it? Do you hold it? This is really a question around how do you know when to sell? And, another long-time commenter on one of my videos, I gotta start learning people's names here. That would be much more personal. Asked me about this company that he found through the magic formula. It's I think a smaller gold mining company. And he bought it not that long ago. It's up 3 times. And he was asking, what do you think of setting a limit, a limit sale price where, say it's at $12.50 per share right now, maybe set it at, if it gets down to, say, $11, it executes a sell. And that protects you. It kind of preserves the gains that you've had in a company. And I've always had kind of a bias against limit orders, because my thoughts are, if you're going to buy a company and you're going to buy it as an ownership stake in a business because you believe in it over the long term, why would you let volatility, why would you let price fluctuations dictate when you're going to sell, right? But I dug into this company a little bit, and I tried to understand, all right, is this a company that could be a compounder over time? Is this a business that deserves to grow, right? Is it one to hold in a portfolio? And things I look for around that, I look for Value Investors Club write-up to try to understand the business better from a great investor who's already looked at it and has formulated a thoughtful analysis of the business. Look at Dataroma. Are there super investors who own this company? Look in corner of Berkshire and Fairfax. What are people saying about it on the message board around this investment idea? And I couldn't find any of that. So, and the company had a fair bit of debt as compared to cash and compared to annual operating income. And so I got to thinking about it, and I realized, well, maybe this is a good candidate for setting a limit order, a limit sell. Because a 3x on a company that you just buy because it's on the magic formula, that's pretty great. That's a very little amount of work that was done to buy that stock. And you can't be disappointed with a 3x, but you will be disappointed if after it goes up 3x, it comes back down and maybe even goes below its original price. That would be quite discouraging. So my 2 thoughts on that were, well, one, you could sell half of the position or maybe even 2/3 of the position and just let the rest ride, and then at least then you can't lose money. Or with something like this, where it's got the tailwinds of what's happening around gold behind it. I kind of like the idea of a limit order for something that's already gone up quite a bit in such a short amount of time. So when a stock you own hits intrinsic value, and that was kind of a tangent, do you start selling, sell all, or hold? It really depends on if you think the company, if you think the business is going to continue to grow, is going to be more valuable 2, 3, 4, 5 years from now than it is now, and that the stock price is fair today. So if it's fair 2, 3, 4, 5 years from now and the company grows, then maybe you're going to do quite well just by holding it. So it's really about, is the company a long-term, like you believe in the business over the long term? Then it seems to me like you should just hold. If you don't really know anything about the business and you just bought it because it was on one of these screeners and it seemed like a compelling price, at that point maybe you consider selling a portion of it and letting the rest ride, or getting out of the position, especially if you have other investment opportunities where you want some capital to put to work in those. So just my thoughts on that. And then finally, last question. Why are Apple and Tesla really doing stock splits? So there's all this talk about, they're doing these splits so that investors who don't have as much money can participate in, stock ownership in those companies. So if you have a lower share price, it means more investors can invest in those stocks. I've said this before, but with the prevalence of fractional shares, access to fractional shares, I have a bit of a hard time with that argument. I did mention it to one of my housemates, and he said, well, maybe with people who aren't as technologically savvy, like older investors, fractional shares might be too complicated, or they're not using those more tech-friendly platforms like Robinhood or some of the apps for their investing. And there could be something to that. I don't have too much of an opinion on that. Really why I think Apple and Tesla are doing these stock splits is it's about the psychology, right? It's not that if the price gets lowered because of a split, more investors will have access. I think there's something when you see a stock that's priced at 100, 80 to 100 versus 400 or 500 in the case of Apple, there's something psychologically where it just seems like a better deal because the price is lower. As value investors, we know that that's not the case. But obviously, a big part of investing, Buffett said, to be a great investor, there's really only 2 things you need to learn. You need to learn how to value a business, and you need to understand investor psychology. So these stock splits could really be playing to the investor psychology piece, where it's just easier for people to spend $80 on a stock versus spending $400, or in Tesla's case, $1,600, $1,700. It could be purely psychological. And, I'm open to the possibility that these stock splits are actually going to benefit these companies. Even though as value investors, we know the market cap doesn't change when you do a stock split. The company's equity is valued the same. It's just, you have the same pizza and you've got more slices now. You're just cutting up the pie into smaller slices. But the more I think about it, the more open I am to the possibility that it's smart for Apple and Tesla to be doing these stock splits. So it'll be interesting to see how that plays out, obviously we won't know if the stock split was the thing that was responsible, if these companies continue to increase their market caps, continue to increase in value. There's obviously multiple factors there, and we can't really tease them apart. But the more I think about it, the more I understand kind of the investor psychology argument to these stock splits. So I will leave it at that, guys. Let me know if you have any questions you want me to tackle this coming weekend on Saturday. And let me know if you disagree with the way I answered any of these questions. I'm absolutely open to expanding my kind of thought process around these things. And it's really a big part of why I have this YouTube channel, to get feedback from you guys and expand what I currently know and think I know. So with that, I will leave you guys for today and see you in the next video. Take care.